The live intraday price for BKYI International Inc., trading under the ticker BKYI on the Nasdaq, is $0.6358, reflecting a sharp minus 5.70% drop today, November 6, 2025, as of 1:19 p.m. EST, following an open at $0.6608. This significant single-day pullback immediately begs the question of whether the market has already factored in and is now selling off the truly positive news that hit the wires earlier, the announcement of a major defense contract secured by the company in the Middle East. While retail chatter often focuses on the pre-market spike, which was quite substantial, the real insight here is the swift reversal and consolidation back toward the low end of its 52-week range. The common expectation for a stock like this, a micro-cap technology name, is that a headline contract in the security sector, especially one deemed one of the largest security sector deployments in the region to date, should cause a sustained lift. The reality, however, is that this kind of sharp intraday retracement suggests a deep-seated institutional skepticism regarding the company's ability to translate one-off contract wins into predictable long-term profitability, or perhaps a tactical sell-the-news event driven by short-term traders capitalizing on the initial euphoria. This tension between a headline contract win and the stock's refusal to hold its gains is where the deeper analysis must begin, especially for a stock that has seen its value erode by almost 62% year-to-date and 46.66% over the last year. The immediate stock action centers entirely on the news from this morning concerning the Middle East defense contract. In the world of online investment and self-investing, this kind of news is exactly what excites individual brokerage accounts and platforms like Robinhood stock trading users, who often focus on momentum and major announcements. The pre-market move was explosive, driven by the perceived value of an identity and access management solutions provider entering the high-assurance government and defense environments of a politically sensitive and high-spending region. However, as the session progressed, the selling pressure became undeniable. The trading volume, while elevated at 294,010 shares compared to recent averages, needs to be considered in context of its average volume of over 5 million, indicating that while there was a burst of activity, it didn't sustain the upward trajectory, which suggests a lack of deep-pocketed, long-term buyers stepping in during the regular session to absorb the selling. This movement is a classic example of how macroeconomic pressures and a difficult overall market, with Nasdaq jitters over AI valuations and other big tech stocks dragging, can override company-specific good news, particularly for smaller, more volatile names. Investors holding BKYI, or those considering adding it to their intelligent portfolio, need to understand that the narrative of a security firm winning a big contract is being immediately challenged by the company's financial structure and its place in the broader risk-off environment. Zooming out to the recent stock performance, the day's movement is less an anomaly and more an intensification of the stock's recent trend. Over the past week, BKYI has fallen over 24%, and over the past month, it's down nearly 18%. This stock has been languishing near its 52-week low of $0.6152 for some time, making the sudden pop on the defense contract news highly susceptible to profit-taking. This pattern often occurs with microcap stocks, a large percentage move on low absolute volume, followed by an equally sharp correction as momentum traders exit their positions. The 52-week high sits dramatically higher at $3.68, a stark reminder of the immense destruction of shareholder value that has taken place, likely due to successive dilutions and the company's continuous struggle for profitability. Institutional activity has been relatively muted, with the short float percentage quite low at 0.36%, indicating that the selling pressure today is likely coming from short-term retail traders and possibly long-term holders finally capitulating, rather than a coordinated short attack. This kind of volatility, where a stock swings over 5% in a day, highlights the high-risk, high-reward nature of investing in companies at this end of the market capitalization spectrum, which currently sits at a meager $4.36 million. Even platforms focused on investment help, like those supporting Schwab Intelligent Portfolios or Interactive Brokers Trading, would flag BKYI as extremely high risk due to its low market cap and high historical volatility. To truly understand the reality versus the market's expectation, we must look at what BioKey International actually does and its financial health. The company operates in the identity and access management space, specializing in biometric security, particularly their proprietary identity-bound biometrics, IBB. Their core offering is the PortalGuard Identity as a Service, IDaaS platform, which provides multi-factor authentication, single sign-on, and self-service password reset capabilities to enterprise, government, and education sectors. They have been in the business since 1993, which is a long time in the tech space, providing solutions that include biometric handheld scanners such as the EcoID 3 alongside their software. The business model is a mix of subscription services, perpetual software licenses, and hardware sales, with the push being towards a higher proportion of recurring subscription revenue, which typically offers better, more predictable margins. For example, the company recently announced partnerships with California EdTech JPA and the Wyoming Department of Education, demonstrating ongoing traction in the education sector. The latest news on the Middle East defense contract, therefore, fits perfectly into the stated business strategy of expanding their high-assurance solutions into government and defense. However, the reality check comes from the financials. As of the Q2 2025 report, the company reported revenue of $1.70 million, showing a nearly 49% year-over-year growth, which is a strong growth number, driven by increases across all three segments. This growth is the basis for the expectation of a turnaround. The sobering reality, though, is the net income, which remains negative at minus $1.17 million for the quarter, and an EPS of minus $0.20. While the losses are narrowing, an improvement of nearly 30% year-over-year, the company is still not profitable. The trailing 12 months TTM net income is still a loss of minus $4.03 million on $6.91 million in revenue. The balance sheet shows $2.28 million in cash and short-term investments and total liabilities of $3.66 million, which is manageable, but the firm is clearly in a perpetual cycle of needing to convert contract wins into sustained, recurring, and highly profitable cash flow. The price-to-book ratio, currently around 0.67, might suggest that the stock is trading below its tangible asset value, which value investors on Fidelity Investments or a Fidelity brokerage account might view as a positive. But this is often negated by the continuous negative earnings and the risk of further dilution. The company's previous financial reports, including the trimming of its 2024 net loss by 49%, do indicate some success in cost controls and improving gross margins, currently around 78.71%, but the operating expenses remain a significant hurdle to cross before reaching sustained profitability. This history of high gross margins combined with net losses is the classic high-potential, high-burn identity of a small tech firm. Looking ahead, the future outlook for BKYI is a balance of significant opportunity and immense execution risk. The opportunity lies squarely in the identity and access management sector. The global push for digital transformation, cloud migration, and secure remote work, accelerated significantly over the past years, has made robust multi-factor and biometric authentication absolutely essential. BioKey's focus on identity-bound biometrics, which goes beyond simple password alternatives by tying the identity directly to the physical user, is a strong technological differentiator in a market with major players. The new defense contract is a key catalyst. as it provides not just immediate revenue, but a crucial reference for winning similar contracts in the high-security, high-margin government and defense sectors, a critical segment for any company in the cybersecurity space. The transition to the PortalGuard IDaaS cloud platform, which aims to become the primary revenue source, is the correct long-term strategic move, aligning the company with the SaaS models that have rewarded shareholders of companies like Apple stock and NVIDIA stock over the last decade. Furthermore, the average price target from the single analyst currently covering the stock is $2, suggesting a massive implied upside of over 193% from the current price, which represents the pure expectation of a successful strategic pivot. The reality of the risk, however, is substantial. First, there is the threat of continued dilution. The company has a history of issuing shares, which increases the total share count, currently around 6.86 million outstanding, and puts downward pressure on the stock price, keeping it in penny stock territory. Second, competition in the IAM space is fierce,